Hi, Sri Sokomoto with Caliber Real Estate Group. It is August 1st with the market report for this month. We are going over some stats that the experts are talking about regarding the housing bubble. And we're going to go over mortgage debt, risky loans, home equity, inventory, all of that good stuff. So with the moratorium coming to an end, everyone's question is, are we in a housing bubble? And this first graph goes over risky loans in 2006 versus where we are in 2020. Mortgages that had a borrower with under a 620 FICO score were at $376 billion worth of loans in 2006 versus only 74 billion people with that lower credit score as of 2020. If you look at the historic data for mortgage credit availability index during the bubble in 2006, we were up to 868, just over 868, and today we're down to 129. So you can see the difference back then versus now, where underwriters and the loan originators weren't really too strict on who they were giving loans to, which is the exact opposite of what is happening right now. Okay, so one of the headlines that, if you haven't already heard, is that mortgage debt is up. Monthly mortgage payment has increased significantly, almost 20% since January of this year. So we've gone from just a payment of nationwide, obviously, of just over $1,000 to just over $1,200 in just a 5-month span. Why is that? Well, because people were stuck at home, they were having to work from home, they were working out, kids are going to school from home. So if you look at the money that is being saved, most people are still working from home, so they're not having to pay gas prices for that commute. Some people got rid of gym memberships, so that went away. So people are taking money that they were spending, going out and eating all the time, and have readjusted their lifestyle so that now that jump in monthly mortgage payment has come off of some other expense that they're no longer seeing. This next slide talks about the household debt versus disposable income. So this is another headline you're going to see, that mortgage debt is up, and it is. But if you look at it versus disposable income, we're down to 3.45%. Even if you go back to the 80s, we were at 4.3. And at the top of the housing bubble, we were at 7.2. So we're less than half of what we were back in 2005, 6, 7, because it's all relative, right? You hear the news story saying mortgage debt is high, it is. But if you look at it versus disposable income, we're really low percentage-wise. Okay, so everybody is saying that people are cashing out their home equity, and it's been the highest and it's been in 10 years. Okay, so this graph shows you that in 2006, there was that high red bar, there was $320 billion worth of cash out refinances happening. So far in 2021, this is the first quarter, it's at 41 billion. Okay, so we were at 320 billion in 2006 at the peak. So let's just say at the end of 2021, we get up to 164 billion. That's still half of what we were at the peak of 2006. So you have to put it in perspective of, yes, it's the most in 10 years, and yes, that's scary when people put it to you that way, but if you look at it relative to what it was at the peak, we're at just about half of what that was. Now, this next graph is talking about tappable equity, meaning if you were to do a refinance, you can only pull out you can only have a loan to value ratio of 80%, right? So this is saying not even beyond that 80%, there is $8 trillion worth of tappable equity in homes right now on average. Most home owners have on average $216,000 in equity right now. So yes, people are pulling out more on home equity refinances, but they also have more equity available to them because the values have increased. So again, when you're hearing those stories of we're at the highest number of cash out refinances in the last 10 years, mortgage debt is super high, you have to look at it to relative to what is happening today in debt to income ratios and all of that other stuff that play into it, and not just buy into these headlines that are trying to scare everyone. Okay, housing affordability. The higher the number is, the more affordable a house is. So you can see in 2006-07, housing was super affordable. That was right after the crash, right? We're looking at this right now. We are not as affordable as the previous 2 years. But if you look 3 years back, we are more affordable, right? Because the higher the number, the more affordable the house. So we are more affordable than 3 years ago. And if you look historically back before the crash, we're still more affordable than we were in the 80s and 90s. It is still more affordable because of higher wages, the low interest rates, all of that combined makes up the housing affordability. So when people say that they just can't afford it or they don't want to pay this much, you have to put it in perspective to timing, right? The people weren't making as much in 1990 as they're making right now. So it's all relative to everything else that is happening that goes along with not just the price of the home, interest rates, all of that other stuff. Affordability is beginning to decrease, right? We went from January where we were at 186 and now in May we're at 151. The experts are predicting that that's going to continue. It's not going to be anything alarming because we just looked at the previous graph showing we are way more affordable than we were prior to the crash. So again, if you are thinking about buying now or waiting, now is probably the answer, just because the experts are predicting that affordability will continue to decrease as we go on through the year. Okay, the last piece that we're going to talk about is the inventory. So if you look at this graph is going over new construction homes, and if you look at 2004, 5, 6, that the home builders were putting out record number of new single family homes. Obviously, after the crash, that dropped way down, and you can see 13 years below the 50-year average of us having less homes coming to market as new construction. So after we had record-setting number of years of new homes being put to market, after the crash, the builders are still trying to recover from that. So now we have not only families staying in homes longer, we also have less new construction coming to market, which creates that inventory shortage. All of it put together just simply says that this is not a bubble, and it's a lack of inventory, right? We have loans that are strict. The underwriting guidelines are strict. We have home mortgage debt is up overall, but looking comparatively to what the income is low. We have more equity in our homes. $216,000 is the average amount of equity homeowners have right now. And we have a low inventory. So it's not a bubble. It's just it's a combination of all of those factors, right? If you have any questions, please feel free to reach out to us. We'd be happy to give you an analysis of your home. If you're thinking about buying, we can sit down and come up with a game plan special for you. Thanks so much for listening. I know this one was a little bit longer than usual.